We are about one little bond market panic away from the end game beginning, in my estimation.
Scott! Let it go.
Don't worry, I know what I'm doing.
Hey guys, Rafa here from the Endgame Investor, and today I want to talk about Scott Bessent and his move to refinance the Treasury's debt by buying back long-term bonds and funding that acquisition with short-term bonds. This makes as much sense as somebody paying down a fixed-rate mortgage by borrowing on the short end when short-end interest rates are higher than what he's paying on the mortgage. Does that make any sense? Not if you're trying to save money, but it does make sense if you need liquidity on the long end, meaning you need long-term interest rates to stay low because you can't stop buying houses and you need to keep borrowing more and more and more money to buy house after house after house at an exponential rate, just as the US government has to go into debt at an exponential higher and higher rate all the time. Basically, right now, it's Scott Bessent versus the world.
Scott earned the power of self-respect.
He's trying to give the bond market a little bit of a reprieve before it implodes, but I don't think it's going to work. And one thing that this channel emphasizes over and over again that other channels do not is that the dollar is the bond market. It is the Treasury market, because the definition of a dollar is everything that is on the Federal Reserve's balance sheet. Why is that? It's just definitional. The dollar is an issuance of the Federal Reserve. The Federal Reserve buys assets and issues dollars on the other side of those assets. Most of those assets is Treasury debt. Some of it is mortgage-backed securities, which index themselves on the benchmark of what Treasury debt is, or the rate of Treasury debt. So if Treasuries go down, that means that the value of the dollar falls. And when the value of the dollar falls, that means that gold goes up, not because people are buying more gold or they decide to, or that it's some kind of cognitive decision. It's that the dollar and gold are mirror images of each other. So as the dollar falls, as interest rates rise, that means that gold must go up to balance that, because you know what? Gold is also on the Federal Reserve's balance sheet, which means when bonds go down, gold must go up to balance it, which is why the strongest gold bull market ever was during the 1970s until 1980, specifically when interest rates were rising strongly. All of the stuff that Keynesians say that lower interest rates stimulate gold buying is crap. It's not true. And we can expect that when interest rates, long-term interest rates, break the highs that they were at, about 5.32 on the 30-year, before Bessent announced his buyback program, that means that the bond vigilantes are coming back and they are going to attack the Treasury. And when they do, gold is going to go up and up and up and up. And it would lead to the end game of the dollar and a repricing of everything in terms of gold and silver. Before I show you some pictures, this video is brought to you by my Substack. Check it out at endgameinvestor.substack.com, where I explain this phenomenon very simply in the link in the description below. Also, before gold explodes when interest rates rise above 5.32, you probably want to get some gold and earn interest on it with monetary metals. Link at the description below. That's where I have most of my gold, not all of it. I do keep a small amount with me. And to do that safely, check out the Dirty Man Safe. Use the code ENDGAME10 at checkout for 10% off your Dirty Man Safe. Keep some away from you, keep some with you, cover all your bases, and let's go on with the slides. First of all, we have this page from fiscaldata.treasury.gov, which shows the average interest rate that the Treasury is paying on bills, notes, and bonds right now. Contrary to some belief, I wouldn't say popular belief, but there is a misconception that higher interest rates means that the Treasury is paying more on its debt. Well, a little bit that could be true, but when the Treasury sells, let's say, a 20 or 30-year bond, it locks in the interest rates on the primary market that it sold those notes or bonds for. If it's a 30-year bond, it locks the interest rate for 30 years. If it's a 10-year note, it locks that interest rate in for 10 years. On the secondary market, people who buy those notes or bonds on the secondary market can get a higher rate, but that doesn't change the rate that the Treasury pays, except if it's selling a bill for 3 months and then it sells another bill for 3 months, whatever the interest rate is on the 1 month or 3 month, it will pay that for the next 1 month or 3 months. So if the Treasury is selling bonds, and it says here at an average interest rate locked in right now of 3.442, and selling bills to fund that at 3.758. Well, what's higher, 3.442 or 3.758? If they're buying back lower interest rate bonds by funding it by higher interest rate bills, they are losing money. And why would they do that? As I explained before, if you need low interest rates on your bonds because you plan to keep buying and you need to be able to lock in rates at 30 years, and you don't want those to go too high, so you will temporarily fund those purchases with short-term bills, lose money on the trade, and hope that long-term yields stay low. But if they don't, it belies the fact that your little hocus pocus trick has failed. And if 30-year Treasury yields, as we can see over here, in the 25-year chart over here, if they rise above this high of 5.28, 5.32, you can see here, it says here 5.28 and now 5.214. So yes, long-term rates appear to have very, very slightly dipped down because of this little buyback program that Bessent has announced. But if they go above this high of 5.28, I think the actual high was 5.32, that means that the bond market has not bought this little trick that Bessent is attempting to do. And fearing that, he probably released some kind of little leak to CNBC, which now says in this article from August 24th by Steve Leisman, Bessent could tap near $1 trillion Treasury general account to fund bond buybacks, sources said. So this headline is trying to make it seem that Bessent is going to spend $1 trillion on buying back long-term bonds. Well, the outstanding amount of long-term bonds is about 5.4 trillion, I believe. So he's going to buy back what, about 20%, a little bit less than 20% of that total and fund it with bills. That's crazy. That's insane. What does it say here? If you read down into the fourth or fifth paragraph of this article, you'll be able to tell that it's a bunch of crap and it's not true. Bessent is not going to spend $1 trillion on bonds. It's just a headline that he wanted CNBC to publish. How do we know this? Because it says here, the officials would not say how much, if any, of the TGA. The TGA is the Treasury's checking account, which has about $100 trillion in it, $1 trillion in it. How much of the TGA, if any, would be used or when such an announcement could be made. There was no implication it could be used beyond the purchase of off-the-run securities that were the focus of last week's announcement, but they were clear that it is considered to be available. So while they wanted CNBC to know that this $1 trillion nearly is considered to be available, they didn't provide any details on whether it would actually be used. So this is just trying to jawbone the bond market to make them think that he is going to use this money to buy bonds when he's not going to, because if he does that, he's going to have to refill it with short-term bills, and that would make it almost impossible for the Fed to hike, because if most of the Treasury's debt consists of short-term bills, then when they hike rates, it's going to hike the entire or most of the debt burden of the Treasury, which is going to hike interest payments on the national debt a lot faster than had most of the debt been long-term. And where are we right now? We are about one little bond market panic away from the end game beginning, in my estimation, which means that the bond market is going to start to fall. And when there is a little bit of a bond market panic, the Fed is going to have to step in and buy the bonds that the market does not want to buy. And when that happens, it will begin the final printing round. And when the final printing round begins, the dollar has maybe a few months, maybe even a few weeks to survive, and gold and silver will go up and up, which isn't really gold and silver going up. It's just the dollar dying. And because the dollar is mostly bonds, as bond market prices fall, the dollar falls with it. And as the dollar falls, Bitcoin is going to fall too, because Bitcoin in the end is still a dollar derivative. And the dollar is still a gold derivative with a whole bunch of debt on top of it. That's true. And that debt pile is going to increase as the Fed is going to be forced to buy what the market doesn't want. That should happen pretty shortly when 30-year yields go above the high of about 5.32. What happens then? I guess we'll find out pretty soon. If you liked this video and you want to know what the Bible says about gold and silver standards, the last video we did on the Patreon, which you can join for as little as $3 a month, which won't be worth anything pretty soon, and I just do that to keep out the trolls, is how do we know that the Bible supports a silver standard? Not a gold standard, but a silver standard. I have the verses. If you're interested in knowing, check it out in the link in the description below. And I'll see you guys pretty soon. For now, it's Scott Bessent versus the world, and the world is going to win. Scott!